What's going on, guys? Welcome back to another video here. So in this one, we have a lot to talk about with what's going to be happening with the market later this week. Tomorrow is going to start the onslaught of economic data releases that are all going to be market moving. Now, along with this, we also have this interesting situation with Goldman Sachs right now and the potential for a very interesting squeeze, something that we've talked about a little bit in the past. So again, guys, before we get into all of that information, if you do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it helps us out a whole lot in getting this information out to as many people who want to learn. And if you do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So coming over to the chart here, looking at the SPY on this daily time frame, currently, at the time that I'm recording this, there's about an hour left until market close. We're battling with that daily 13 EMA. Now, if we do get a close down below, that would signify, again, just looking technically here, that we could be in for some more downside, and we could be going to test that 48 EMA on this daily time frame right around 387. Now, again, all of the other indicators here are starting to paint that picture as well. You have a little bit of a double top here around this 200 EMA on the daily, and things are starting to move back lower. The MACD is losing that bullish momentum. The RSI is crossing down below its moving average, hasn't quite gotten down below 50 yet. And when we take a look at this on the 4-hour time frame as well, remember what we've been talking about. If I was looking at this chart on the 5-minute time frame, and this is how it looked on an intraday basis, well, it was losing its momentum, and it looks like it's about to come down to the downside with the MACD gaining its bullish momentum, RSI crossing down below its moving average, and coming down below 50. Now, again, with the volatility that we're going to be seeing this week, there's a lot of money to be made, but you need to make sure that you're trading with proper risk management, like some of these people over here. We have Odin killing it on the day here, 4% gains. Tabasco Dave coming off of a 60% day with another 1.6% day over here. Again, guys, I can show you gains on gains on gains all day long. But again, it's the system, Pythagoras, Invictus, Trader Joe, the alerts. And remember, this Thursday is going to be the last day for you guys to be able to get access to that $49 member deal that we're offering to all of our existing members in our community. We're moving over to our brand new platform. I can't wait for you guys to see it. And if you are interested, make sure you check out that link down below and come make some money and print with us. But moving along here, taking a look at the dollar, this is to be expected, and this is what we've been talking about in a couple of these videos over the last couple of days here. We saw that initial test of the 200 EMA on the daily here, bounced right back up. What were we talking about when we saw this bounce or coming down to this 200 EMA again here? Well, we were most likely going to see this double bottom and start to move back up in the dollar, which can also be a reason why the market's been trending a little bit lower over the last couple of trading days. You're starting to see a little bit more dollar strength. Now, again, with what we were saying in yesterday's video, you do need to break above this 13 EMA on the daily here and get above this key level of resistance at around 107.66 for DXY or the dollar index. And coming over here and taking a look at the 10-year treasury yields, they are coming down slightly. So people are coming into the treasury market and buying these bonds. And what that can tell us as well is that you're seeing a shift out of equities and into bonds, a little bit more risk off than you would typically see in the market that we have witnessed over the last 2 years. Now, when we think about where this volatility is going to be coming from this week, before we get into this Goldman Sachs situation, which I find really interesting, we have to talk about this right here. So tomorrow, Wednesday, is when all of this data is starting to kick off. ADP unemployment report, definitely going to be market moving. Real GDP revisions, that is going to be a very important piece that people are going to be watching for, and a data point that people are going to be watching to really see, okay, how have these revisions gone in terms of how has our growth actually been over the last quarter. Now, looking at this even further, we have job openings at 10 a.m., job quits at 10 a.m., pending home sales index as well. And we're also going to be getting Jerome Powell speaking at the Brookings Institution at 1:30 p.m. Now, in my opinion, Jerome Powell is not going to come out and say essentially statements that are going to be as market moving as they would be during a normal Fed meeting. Can he say something that's going to move the market? Yes. Yesterday, when we were listening to or reading the statements as they were coming through from Bullard and John Williams, those were very market moving. And when we come over and take a look at the charts of when those people were speaking, well, There was a lot of volatility coming into the market here. So again, it's possible that Jerome Powell does say something that is going to be wildly market moving. In my opinion, though, with the FOMC meeting coming up in about 2 weeks, he's going to be speaking more so on things that have happened in the past and not necessarily giving any aggressive future guidance. Now, let's get along to this Goldman Sachs situation and where hedge funds have actually been shorting over the last essentially year. Now, when we look at this right here, last week when we recapped Goldman's quarterly hedge fund monitor report, which is the most detailed breakdown of hedge fund activity in the prior quarter, we pointed out something remarkable. While the hedge fund VIP list of most popular long positions continue to dramatically underperform, let's see here, i.e. suck, as the hedge fund hotel model works very badly during times of broader market downturns. What was far more interesting was the list of very important short positions, or VISP, where at the very top was none other than Exxon, which has doubled this year and quadrupled since it was kicked out of the Dow Jones. As we said last week, judging by how much short covering Exxon still faces, it's not necessarily a large percentage of the float. It's more so a dollar amount that is actually shorted on Exxon, not to mention how much more buying lies in stock as hedge funds rotate from being short to going long energy. Exxon may very well double again from here. Now, that's the assumption, or essentially the opinion of the individuals writing this, but there's something very interesting about what's going on with this energy situation. And sure enough, according to Goldman Prime's latest report, energy was the top shorted sector notionally on the bank's prime book last week, with short sales outpacing long buys 6-1. Here's why this is interesting. We are going into these colder months. We still see the conflict between Russia and Ukraine, which is messing with the price of oil in the oil market. We're seeing OPEC come out and cut production, and they are looking to cut production again. Now, what happens when you cut production of a good, lower the supply when the demand is still the same, or maybe even higher going into colder months? Well, the price is going to go up. Now, the other thing that's interesting here, again, Europe is still facing their energy crisis, but when we come over here, Goldman Sachs sees high probability of an OPEC cut and expect oil prices to hit 110 by next year. So Goldman Sachs, the financial institution, thinks that oil is going to go up. All of their clients, or a lot of their clients on the VIP hedge fund list with very important short positions, are shorting the energy market. There's something going on here that we as retail investors are not seeing, that when Goldman Sachs says, we think oil is going to hit 110 next year, but a lot of their institutional clients are saying, nope, we want to be short energy. There is something wrong. Now, here is what it could be. It could just be a hedge. There could be people out in this market right now thinking that energy to the downside after being up so much this year is a decent hedge in the overall market as things start to stabilize going into 2023. The problem is that if they don't stabilize and we see this Russian-Ukraine conflict continue and you continue to see the energy crisis persist over in Europe and you just continue to see OPEC cut output as well, well, then oil prices, energy prices in general, are most likely going to continue to go up, increasing the value of these energy stocks and forcing these big shorts out of their position. Now, when we come back over here and take a look at this article here, let me see if I can find right here. So yes, during the previous week, when many energy names hit fresh all-time highs, instead of cutting losing tech longs, hedge funds were sextupling down on their energy shorts. And as Goldman Sachs Prime further adds, U.S. energy stocks have been net sold 6 of the past 8 trading sessions, and last week's notional net selling was the largest in over 5 months. So this creates an interesting scenario here where as we continue to get into these colder months and the energy crisis persists, well, one, these funds could face some pretty significant issues. In addition to what they've already seen this year, if they've been increasingly long on tech, which again, energy's been going up and tech stocks have been coming down. If you're long tech and short energy, you are having an absolutely terrible year. So this is going to be something that we need to keep an eye on because we've been talking about a lot of these energy stocks. Oxy, I've been talking about that stock all year. Exxon, we've been taking a little bit more of a deeper look into. We've been trading natural gas as well, but these are things that you guys need to be aware of in this marketplace where you can have pockets of really, really good opportunities. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So that's going to wrap it up for this one. I'll see you in the next one. Peace.